I would be very positively surprised if we would get a deal tonight. There's been a lot of back and forth between the technical level and the political level. We have not seen a concrete proposal yet, and we have to deal with it very carefully based on our parliamentary mandates.
I think the first point to say is that compared to the previous crisis we've seen in Europe, the market reaction has actually been quite calm relative to what we've seen in the past. And I think that's quite an important point, because that also conditions a lot of the negotiations going on at the moment. There's clearly a belief in the markets that the rescue mechanisms, the ESM, the OMT, and then ultimately as well the QE policies are there and containing that risk of something getting ugly here.
That market is dominated by individual investors who are buying stock on margin. There's about 1 million brokerage accounts a week being opened up by individuals who have precious few options. I mean, they can go to Macau and gamble, or they can buy stocks in China, and it looks like they're doing the latter.
It kind of feels like the late 80s in Japan, doesn't it, for these individual investors?
To me, it is 1989 in Japan. I mean, everything that we said about Japan in the late 1980s, we're saying about China today, about their dominance, about their, in some ways, superior, you know, in Japan's case, mercantile system, in China's case, state-controlled system. But, you know, when you really take apart the Chinese economy, it's not that strong. There's a lot of overcapacity. One reader complained that I conflated our debt levels with total debt levels in China. But their debt is different than ours. I mean, if you look at state-owned enterprises, their corporate debt is government debt. If you look at municipal debt, that's what the government's buying there as part of their QE. So when you look at debt levels, they're actually scarier in China than they are here in the States.